Prior to the beginning of today's discussion, I must read the following disclosures. Equity investments are affected by market conditions. The intrinsic value of stocks in which our portfolios invest may never be recognized by the broader market. The opinions expressed are current as of today, August 17, 2021, but are subject to change. The information provided in this podcast does not provide information reasonably sufficient upon which to base an investment decision and should not be considered a recommendation to purchase or sell any particular security. Portfolio holdings are subject to change. The performance of any single portfolio holding is no indication of the performance of other portfolio holdings of any strategy or fund. Comments made on any individual company or security is not an indication that it is currently held in a portfolio, nor is it an indication that it ever will be held in a portfolio. Thank you all for joining us for this Convertibles edition of the Gabelli podcast series. This is Terry Pope, a member of GAMCO's institutional team, and with me is James Dinsmore, portfolio manager of the convertible strategies here at GAMCO. We've been an active convertible investor since 1979 and today offer institutional separate account strategies, a UCITS fund for offshore investors, and 3 closed-end funds. For the next 20 minutes, I will host a conversation with James where he'll share investing insights for convertible strategies. Welcome, James.
Thanks, Terry. Thanks for having me.
So let's begin with a summary of the convertibles market. Why do companies issue convertible securities?
Okay, so quickly, the convertible market globally, it's over $500 billion with about 900 issues outstanding. The U.S. makes up about 3/4 of that, with about $400 billion in assets and over 600 issues outstanding. It's grown substantially over the last few years, and companies have used it. They've turned to converts as just an inexpensive way for them to raise capital. So traditionally, issuance has come from more growth-oriented companies who they sort of view the market as a way to raise capital that's just less expensive. From an interest perspective than high yield and less dilutive than equity. So as a result, over the years, there have been a lot of technology and healthcare names in our market. Over the past 18 months, really since April of 2020, March of 2020, we've seen the market grow substantially because companies can come to the market quickly and raise capital as they view inexpensively. We saw a lot of companies in the retail space and travel space and consumer space come to the market last year because the convertible market was open to new issuance more quickly than some others right out of the gate.
So convertible securities take the form of bonds or preferred shares. And what type of convertibles does your team invest in?
So we look at every type of convertible. The market as it stands now is roughly 80% convertible bonds. It's about 15% mandatory convertible preferreds, and then about 5% convertible preferreds. So the overwhelming majority is in convertible bonds. But we definitely look at mandatories and preferreds as well. Mandatories can be an interesting way to increase our yield. And if it's a name that we like, they're a little bit more equity sensitive than traditional convertible bonds are. But if it's a name that we like, we can pick up that name and get some yield from it as well. So we look at all aspects of the convertible market, and we try to stay familiar with all of the issues that are available to us, certainly here in the U.S.
So it is well known that some convertibles may offer an asymmetric return pattern. Can you explain what this means?
Absolutely. So that's one of the things that we like most about convertibles is their asymmetrical return pattern. So what it means is that you're sort of getting the best of both worlds. Of you're getting equity upside and sort of fixed income downside. So in a typical convertible issued at par, as the equity moves higher, the convertible is going to move higher, and over time it will become more equity sensitive. So as the equity moves higher, you will get more of the equity upside as time goes on. So whereas on the downside, if the equity moves lower, the fixed income characteristics start to kick in. So basically, if a company's fixed income, if a company has debt outstanding that is trading at, call it a 5% yield to maturity, as the convertible approaches that level of a 5% yield to maturity, the downside will slow substantially, and eventually it will just sort of trade in line with the fixed income. So even if you have an equity that's down, 30, 40% for whatever reason, often you end up with a convertible that is sort of flat or down maybe 10% over that time frame in sort of total return terms. And so you're not picking up all that equity downside, whereas as the equity moves higher, you're getting more and more of the equity upside. So that's sort of the asymmetrical nature of converts that we like so much.
Mm-hmm. So when you're looking for investing in a convertible security, what are the criteria you look for? What makes a good investment?
So there's a few things that we look at. So the way that we analyze a convertible security, we look at three things from a sort of a larger standpoint. So we're looking at the underlying equity and doing a fundamental analysis of the underlying equity. We're doing a credit analysis, and we're obviously also looking at the terms of the convertible. So the way we look at the market, we tend to view it as a way to invest in equity higher up in the capital structure with reduced volatility and a yield advantage over the common stock. So when it comes to the convertible, what we like to see is we certainly like to see a yield advantage over the underlying equity. And that's pretty common, even with interest rates here. We have seen some 0% coupon converts, but for the most part, they come with at least some yield advantage over the common stock. And then we're also looking at what the premium is, the premium to conversion value. So if the premium to conversion value is very high, call it 50, 60%, we saw some of those earlier this year, that's sort of an unattractive convertible for us because it's just, we're never going to see, or it's going to take a lot to get to a place where we're going to see equity upside from that. So we like to see, the sweet spot for us is yield advantage and over the equity and a lower conversion premium. And then, so that's from the convertible perspective. And obviously we're doing fundamental analysis of the equity, looking at the credit. Convertibles are senior in the capital structure to common stock and preferred stock, but they're usually subordinated to some of the other debt. So we need to make sure that we're comfortable with our position in the capital structure. Generally, like I said, just by looking at it as an equity investment, by just the fact that we're moving up in the capital structure from the equity, that's usually beneficial. And then certainly, final piece of the puzzle is the equity analysis. And we work with a team of analysts here at GAMCO and do our own work on each of these names and decide whether or not we think the equity is undervalued. And sort of those three pieces come together and when we're deciding whether or not we're going to make an investment in a specific convertible.
So you spoke a little bit about some companies that are issuing today, but going back during the initial COVID period in 2020, as an asset class, how did convertibles perform?
So convertibles in 2020 was a very interesting year for converts. So we came into the year, there had been a lot of issuance from software companies in 2019 and prior. So we came into the year sort of positioned well for what was about to happen with COVID. So in March, as the market was tanking, converts generally held up a little bit better because they were exposed to the stay-at-home trade and just sort of that side of things. As I said, coming out of March, the convertible market was one of the first markets to really be open in an attractive way for issuance. And so we just saw a massive amount of issuance in April and May of 2020, with a lot of these companies and stocks, down still substantially from where they had been. They were issuing convertibles with decent yields and low premiums, so they were very attractive convertibles, sort of as almost a rescue financing for these companies. For companies that were unsure if they were going to have zero revenues for the next month or the next year, they could come to the convertible market, and the market was still giving them money. So what happened was that those, obviously, as the market moved higher, those converts did very well, and so 2020 was a great year for convertibles, in as much as performance was concerned, because we sort of held up through the downturn a little bit better than the equity indices did, and then kind of had more exposure to the recovery trade through the second half of the year, which led to very strong performance in 2020.
So over your very long career investing in converts, how does today's investment opportunities compare to others that you've seen back even longer than COVID?
Sure. So this is the largest the convertible market has been, dating back through the majority of my career in converts. You have to get back to the early 2000s before you see the convert market be as large as it is today. So that's good. We have a lot of opportunities in the market to choose from. Now the issuers are a little larger than they were then, so not quite as robust in terms of the number, but it's still one of the most robust convertible markets that I've had in my career. That being said, the mix of what's available to us in the market is still fairly compelling, and probably more compelling than it's been in quite some time, where we have opportunities in the way that we look at the convertible market. We look at it as their fixed income convertibles, total return convertibles, and equity sensitive convertibles. And we like to be in that total return to sort of equity sensitive space if we have some names that we like. And the diversity of names that are available to us is the largest it's been in 15 years. So that's very compelling. And the setup is good. We have a nice yield advantage over the underlying equities. The median premium of the universe is fairly low. There certainly are some outliers on the premium side of things, but generally the median to conversion value is attractive here, and more attractive than it's been in some time. And the market itself has been skewing a little bit more equity sensitive, but we think there's a lot of opportunity in the total return side of things for us to invest, and we like that.
So let's talk about higher interest rates. This is a buzzword trending. So how do you anticipate that could impact converts?
So rising interest rates generally it's a very good market for convertibles when interest rates are rising. So this is where the equity sensitivity side of things is what drives performance. So generally you think fixed income, interest rates are moving higher, bonds are moving lower. And that's true. Convertible bonds, because of that equity portion, because of that optionality, generally in rising interest rate environments, generally equity are moving higher. The equity is moving higher, and therefore convertible bonds are moving higher. So we've done a study on this, and going back to 1998, there's been 10 periods where interest rates, 10-year treasuries have risen by 100 basis points or more. And in each one of those times, convertibles have moved higher, sometimes significantly so, and often higher than even the equity markets have done in that time too. So a period of rising interest rates is generally good for converts, like I said, because they're being driven by their underlying equity. And one of the other things that we see in a period of rising interest rates is continued issuance. And issuance generally is good for convertibles. And the reason we're seeing the issuance is just because, suddenly high yield looks that much more expensive to companies if they're trying to issue fixed income. They may have to pay more of an interest rate in a rising environment than they would care to. Whereas the convertible market will still accept a lower rate because we have that equity optionality. So generally we like converts in a rising interest rate environment, and we think it's a good setup for converts.
So what about in an inflationary environment? How would you anticipate convertibles to react?
So sort of a similar story, where because the equity performance is what drives convertibles, in as much as inflation is good for stocks, which it generally has been in the past, we would expect convertibles to perform well. It's pretty straightforward on that front. If inflation is moving stocks higher, as we would anticipate that it would, converts will perform with that and do well. Again, we would expect to see sort of the majority of any equity move with reduced volatility on the downside.
So pivoting a bit to our investors, how do converts fit within an institutional asset allocation framework? So
we've had this discussion with a number of groups over the years, and it sort of, to some extent, it sort of depends on who you're talking to. We find we have the most success and the most, we think the best place for them is when you're talking to someone who is thinking about them as part of their equity bucket in the institutional side of things, because what you're getting with converts is over long time horizons, multiple market cycles, you're getting equity index type returns or equity like returns with 3/4 of the volatility. So if you think, you're going to see equities moving higher, you can do it in converts with 3/4 of the volatility. Now that being said, we have had some discussions on the fixed income side, and certainly there are some fixed income investors who look at converts as well. Sometimes it's a little bit more difficult for them to get their head around taking on extra volatility for extra return. But there are certainly some fixed income investors who like the optionality of converts, particularly when it comes to a rising interest rate environment. So if you're in a rising interest rate environment, like I said, you can be in this bond-like structure that has some of the protection of bonds that you like, but it will act differently than traditional fixed income in a rising interest rate environment. So for rising interest rate environments, institutional investors, maybe the fixed income bucket works, but generally over multiple market cycles, we think the equity bucket is a good place for them.
So why should an individual investor consider adding convertible strategies into their portfolio?
So we think it's great for an individual investor as well, for sort of all those same reasons. So, but most specifically, we're investing for total return over long time horizons. So you're getting a mix of income and capital appreciation with reduced volatility relative to the underlying equities of the convertible strategy. So it's honestly, when we talk to people, they often aren't allocating a large percentage of their assets to such a thing, but we think it certainly can be higher. And certainly the investors that we talk to who have been in converts for a long time quite like the returns that they've been seeing and what the reduced volatility can do over time. Like I said, that's really the key to the strategy.
So can you share with us some of your favorite securities today?
Sure. So there's a number of securities that we like. Obviously, we've got a portfolio of roughly 100 names, but I think there's a handful that we have that really sort of tell the story of converts and why we like converts in today's environment. So one of the names that comes to mind is a company called Cardlytics. They have a convertible outstanding. It's got a 1% coupon. It matures in 2025. They do card-based offers. So if you have a credit card account with JP Morgan Chase, you go onto your Chase app, you look in there and it says, hey, you can, here's this offer for 10% off at Starbucks. And you say, okay. And you click on the thing and it's enabled. And the next time you go to Starbucks, you pay, you get 10% back as cash back. So, that's their business. They've got a really great handle on that business, and they have JP Morgan Chase, Bank of America, Wells Fargo, all as banks that have this service. So the converts are trading. They're a little bit over par. They have a 1% coupon, like I said. They have right now the current yield is a little over 80 basis points. So what this allows for us is to participate in what we think is a great growth story for Cardlytics over time, while picking up a yield advantage. And if there's downside, which recently they had a quarter where they had over-guided, essentially, they'd gotten a little overconfident in their guidance. Stock came down. The converts came down with the equity, but less so. And now they sort of set up in that sweet spot of asymmetrical returns. So that's one name. We like another one. Dish has a number of converts that are outstanding. The nice thing here is that we have the opportunity to, we can invest between them. So they have two that we've liked there over the years. They have a 3 3/8 convertible that's convertible, goes out to 2026. They issued this in 2016, so it's been outstanding for a while. It's outperformed the underlying equity over the life of the convert, particularly when you take the yield into account. And it's sort of in a spot where we're picking up some nice yield, and there's some optionality to the upside if Charlie Ergen's plans come to fruition over time. And then we have the zeros from Dish, which traditionally we don't particularly care for 0% converts, but in the context of the Dish complex, they're a little bit more equity sensitive, so we can own the 3 3/8 for some downside protection and some yield, and then we can own the zeros to have a little bit more equity upside there. So those are a couple of the names that we like in the convert space. I guess one other that I'll just touch on real quickly is a company called InterDigital. They basically have a whole bunch of engineers that are creating. They've created the 3G framework, 4G framework, 5G framework, working on 6G, and then they license it to cell phone providers specifically, or anyone who's going to be using these types of connectivities. They have a convert that's outstanding, that's sort of in that sweet spot of asymmetry that we like. It's got a 2% yield. It's trading a little above par. There's very little downside in the convert. We think, the converts will be good at par, money good at par, worst case in 2024. But there's a lot of upside as they continue to bring companies under the licensing agreements. Their recurring revenues can increase over time, and it's a pretty high margin model. So we like that one, and it's a really interesting way to play it in a sort of an asymmetrical way.
So one last question for you, James. What is the outlook? What do you see going forward for convertibles?
Like I said, issuance has been spectacular over the last year and a half. I think all of the pieces are in place for issuance to continue, but it may not be quite at the pace that it has been. But I think companies will look to the convertible market as less expensive than fixed income, less dilutive than equity. They can raise capital quickly. It usually takes them, 24 hours from announcing the deal to raising capital. So that's something I think that companies generally like. So I think we'll continue to see issuance. As I said, performance was spectacular in 2020. In the first quarter of this year, it slowed a little bit. It was just a little bit weaker. We're a little bit more exposed to growth in our market. So as growth to value sort of rotated in the first quarter, that sort of weighed on the convertible market a little bit. We had some issues that came that were not as well priced as we would have liked them to be. That sort of weighed on the market a little bit. But I think we've gotten through all that, and I think we're sort of set up for nice, again, equity-like returns with 3/4 of the volatility moving forward. So I'm very optimistic that we will continue to see issuance and performance out of the convertible market for the next 6 to 12 months. Especially, as I said, if we see rising interest rate environment, inflation, these are all things that should set up well for convertible investors going forward from here.
Well, thank you. And thank you all for listening to Gabelli Media. And we look forward to you joining us for our next podcast.
Thanks, Eric.
In this episode, several companies were mentioned. Our company owns less than 1% of the following: Cardlytics, Inc., ticker CDLX; Starbucks Corporation, ticker SBUX; JP Morgan Chase & Company, ticker JPM; Wells Fargo, ticker WFC; Bank of America Corporation, ticker BAC; Dish Network Corporation, ticker DISH; and Interdigital Inc., ticker IDCC.